When exactly do you prepare to profit from the recession? What actions can you take exactly? This action could possibly help you make 100% ROI. Welcome back to STA Club. By the end of this video, you will know how to position yourself to take advantage of this potential recession everyone is talking about. Today, I want to talk to you about three things. Number one, which yield curves to compare. Number two, how the inverted yield curve behaves versus the S&P 500. What exactly can you do to profit from the recession? Let's begin. Number one, which yield curves should we use to compare? Looking at Fed research findings in this paper, the paper concludes that the best combination is the 10-year versus 3 months yield. Nonetheless, it is okay to use 10-year versus 2-year. You just need to be consistent when doing so. The combination used in this research paper is 10 years versus 3 months yield, so we'll use that today. My friend Ben has presented his findings using the 10-year versus 2-year. This is highly correlated with the Fed using 10-year versus 3 months. You can find his in-depth analysis in the description below. Next, let's see how the 10-year versus 3 months yield curve fare against the market. On the Fed website, we have the 10-year versus 3-month yield. Recession is indicated by the gray shaded area. The graph here spans from 1980s to 2020s. Notice that recession happens only after the inverted yield curve turns positive. Usually, inverted yield curve signals an impending recession, but the recession actually occurs after yields move from the negative territory to the positive. Knowing this, traders like us can be ready to take action when yield curve turns positive. Finally, now we know when to be prepared. What can we do? I will use 3 examples to demonstrate. Let's observe how the S&P index price action moves when the yield difference turns from negative to positive. End December 1989, the yield is positive. Recession only happened almost a year later in July 1990. When the yield turned positive, index traders would profit from the turn in early January. Traders wait for confirmation and look to short in mid to late January to profit from the downtrend. With CFD, you can leverage up to 20 times, which allows your trade to give you a potential ROI of 100%. The next period, end January 2001. Yield has turned from negative to positive. Once again, prices has already been on a downtrend. A possible entry would be in early February when prices continue another leg down. Last but not least, June 2007. Yield once again turned from negative to positive. At this point of time, prices are up and sideways. The drop happened in July, consolidated for a while in early August, and continued down. In summary, we can prepare to take action when yield difference moves from negative to positive. Then, we look out for a lower high before we consider shorting the market. This can be done using CFDs, which is known as contract for differences. And using these CFDs, this can give us a high ROI. Always have your stop loss and target in place for your trades. So trade safe, and I'll see you in my next video.